Hi everyone, this is Dimitri Pargamonik with MarketChameleon.com. I had a question come up. When you're trading options, what's more important to look at, your theoretical edge or your theoretical win rate? And the answer to that is you should look at both because they both tell you something a little bit different. Let me show you what I mean, and I'm going to show an example in SPY, and I'm going to come down here, and SPY over here we ran an analysis and came up with two different trades. They're both bull put spreads in SPY. These are different expirations with different strikes. So this one over here is in December 24th. If you sell the 317 put, buy the 313 put, it says right here we could get a credit of $1.87. The theoretical value here is $1.59. So that's based on historical returns in SPY. What do we think that this option spread would be worth? And this is your theoretical edge. So the theoretical edge is something where what do you expect? How profitable do you expect the strategy to be if you did the same strategy over and over and over again in the long term? And here is the expected win rate or the frequency of profitability. So I'll get into that a little bit more. I'm going to show an analogy, kind of stepping away from options, but here in comparison, here's another bull put spread. This is selling the 299 put, buying the 297.5 put in December 27th expiration. Now you could receive 10 cents credit for it. We think theoretically it's worth 2 cents. So over here, if you're selling it above a theoretical value, that's like edge, because you're receiving a little bit extra. So we could see here that the edge is 5.7%. We could see here lower edge, less expected return over a long period of time, but your win rate is 99%. And just to draw an analogy, I'm going to step away from the options and show you a similar game to options where we're going to set it up where we don't know what the outcome is, but what we could do is think, because options, they're statistical instruments, right? You're looking at what is the probability of the stock going above a certain point in the future or below a certain point. So it's a random event. We don't know, but what do we think is likely going to happen? So it's a statistical probability bet, and I'm going to show you an example of a game here that's a little bit similar, and it's a coin flip. Because a coin flip, we don't know what's going to happen, but we could estimate the probabilities. And here, just to set it up and show you potential edge in a coin flip, let's say you have a coin flip and there are a lot of people who think that the next flip tails will pop up, right? A lot more people who think there's going to be tails than heads. And what happens is there's an imbalance. So some people are willing to pay extra to play that game, right? So they come up to you. Let's say you find somebody and they're willing to wager that if heads comes out, they're going to pay you $1.50. If tails comes up, you pay them $1, right? So that's the bet. That's the edge, right? You will get $1.50 if they're wrong, and if they're right, you pay them $1. And what is the edge here? So first, let's calculate the edge. And let's just say if you're going to play this game many times, right, over a long period of time, then the laws of large numbers will revert to what the coin flip is, 50-50, right? And I just put in 10 spins over here, 10 flips. So, tails comes out, you lose $1. Tails comes out, you lose $1. Heads comes up, you win $1.50. And let's pretend these 10 flips really reflect 100 or 1,000. So let's look at our statistics just in these 10. So here we have 5 wins we make $1.50 for 5 wins, so $7.50. We have 5 losses where we lose $1, we lose a total of $5. So our total return after 10 of these flips is $2.50. So what is our average return per flip? So for each flip over the long term, right, we made $2.50 divided by 10 of these flips. So on average, we make 25 cents per flip, per unit of risk. What is the percent, right? What is our percent or our percentage terms. So in percentage terms, we made 25 cents for each time we risked a dollar, right? So for each of these flips, we risk losing a dollar. So we made 25 cents for each dollar unit of risk. So that's 25% based on the amount at risk. And our win rate is 50%, right? Half the time we won, half the time we lost. So let's just look at the equivalent here. Here's the expected return, your edge over a long period of time if you're able to make a similar bet over and over and over again. And this is the theoretical win rate, 60%. 13.2% theoretical edge, or your expected profits over a long period of time versus the frequency of wins over a long period of time. Now let's come back and take make another game and compare it to a different theoretical edge and different win rate. Just to give an example why you should be looking at both the win rate and the average return. Now I'm going to create a game that's different than a coin flip. This one is spinning a wheel. And let's pretend you have a wheel with 10 numbers. And somebody tells you, here's the bet. If any number from 1 to 9 lands, then they will pay you $1, right? Doesn't matter if the next spin 1 lands, 2, 3, 4, 5, any number between 1 and 9, you make $1. But if number 10 lands, if it lands on number 10, you pay them $15. Okay, so you're risking $15, right? Which here, based on these numbers, will land 10% of the time to make $1, which your win rate will be 90% of the time, right? Because there's nine possibilities out of 10 that you will make money. So let's take a look at what is your edge here and your win rate, and we're going to compare it. So here, let's just pretend you did 10 spins, right? And it'll be reflective of a much larger sample. But out of 10 spins, it landed exactly like this. 9 times, you won $1. 1 time, you lost $15, right? So your total return after 10 spins is negative $6. You collected 9, but you paid out $15. You lost $6. So your average return per spin is negative 60 cents. So every time because you did 10 spins, you lost $6. So on average, it's negative 60 cents, right? And what is your average expected return in percentage terms, over a long period of time? Well, if on average you're losing 60 cents, you're risking $15 for every time, but your average loss is 60 cents. So you're really just, losing. You don't have a positive expected return, right? Because it's negative 4%. And your win rate here, is 90%. So even when you look at here, right, you look at these numbers and let's just compare it over here. Your win rate over here is 50%. Here, your win rate is much higher, 90%. 90% of the time, you're expected to be profitable. But look at the payoffs, right? This one over here is much better because even though the frequency of the wins is lower, your payoff is much better, right? 25%. Here you're losing, right? Look, here per spin, you're losing 60 cents. That's why you want to look at both, right? You want to look at both of them. You want a positive average. It's important to have a positive expectation, positive average returns over a long period of time. And then you want to look at your win rate, which will tell you the frequency of wins, the frequency of times that you will be profitable. But it doesn't tell you your total expected return, which that would be the edge here. Now, one caveat here. Here, when you flip a coin or you spin a wheel, we're looking at whole absolute numbers, right? When you're trading options, it's not absolute. It's more like an insurance company or think of it as, you're estimating the probabilities, right? You're estimating what will happen. Like pretend like you have a 3-point shooter and you're like, do I think he's gonna hit a three, right? Like in basketball, is he gonna make this is he gonna make this shot? Is he gonna sink it? Well, we don't know what the outcome is, but historically, let's say he shoots 70%, right, from three. So 7 out of 10 times he gets it. So then we could estimate based on that. We don't know for sure, but we're drawing estimates based on historically what happened. So that's how options are, and these are estimates based on what historically happened, right? We're looking at what do we think our edges and our win rate based on historical data. So that's the difference between theoretical edge and theoretical win rate, where you kind of want to look at both of them because both of them are telling you something a little bit different. Hope this helps, and see you guys in the next video.